Hello everyone, hope you're doing well. Okay, today we have to begin our topic of external audit. Mainly in our previous classes, we were discussing that what are types of assurances, what is the level of assurance we can give in audit, what are types of assurance services that are available when we are working on organizations. But now getting back to the main point, the main area that we have to focus upon is external audit. External audit is basically a statutory requirement by the governments of countries such as UK, USA, Pakistan, and globally. So, if this requirement is to be conducted, it is to be conducted on multiple grounds, on multiple requirements that are to be studied by us. The governing body is International Standards of Auditing, ISA. So ISA is going to present with us multiple areas where we are going to see some standards, some rules and regulations set by the authorizing organization on which we can conduct an audit. So external audit is basically the examination of financial statements of an entity by an experienced auditor or an audit firm, and it is a statutory requirement for many companies that are basically in the interest of the stakeholders and the public in the country. Okay. Now, audit examination in this type of audit, we are basically giving a reasonable level of assurance. A reasonable level of assurance basically means that we are giving them 80 to 90% assurance, a high level of assurance, but not absolute assurance, that the financial statements are representing everything true and fair, and nothing is there that is problematic according to us. Okay, so let's begin. According to ISA 200, the objective of an external audit is to enhance confidence of intended users by expressing an opinion on whether the financial statements give a true and fair view, are prepared in all material respects in accordance with the applicable financial reporting framework. So to ease it up a bit, they are true and fair. Whatever in the organization has happened is recorded there. Nothing extra, nothing less is mentioned, and everything is according to the financial reporting framework that we follow. That's IFRS document. Now, when we break down true and fair into two distinct areas, true basically means factually accurate, based on reliable accounting records and compliant with laws and standards. Compliant with laws and standards. So every standard is satisfied by the work that we have done. And fair means free from bias, presented with clearly and objectivity, reflecting the commercial substance of transaction, not the intention of the people. Let's say if you have given 1 million rupees, 1 million rupees to someone, okay, now you didn't do your due diligence. You were like, I know that person, my intention was good, etc., etc. But the material amount that you have given to the particular person should reflect commercial substances. Because if you are giving someone the money of the business, then what are you going to operate on? So the auditor has responsibility to check whether the money is that is going in the market, if freely, is for commercial substance or not. There are no hidden agendas here. If we are looking at it, let's say we have a transaction, we give a loan to a person without interest. It falls under IS 24, that is related party transactions. If it falls under IS 24, the regulatory bodies say you have to give an extensive disclosure for it. You have to give extensive details about it. You need to first go to the shareholders and get them approved, get this transaction approved. If you're not doing it, then it is not allowed. You're doing it out of your own agenda. So that will be counted as an ethical effect or a financial reporting negligence. Okay, so you have to be very careful that if you are making a transaction, it should be only due to commercial substances. So auditor will check that whether it is counting treatment done for substances of commercial acumen or you are doing it for your personal agendas. Okay. Next, objective of the auditor: obtain reasonable assurance that financial statements are free from material misstatement. Financial statements are free from material misstatements. That means we will be checking the financial statements and we will be telling or examining the records to see whether there are any substantive errors present in the organization's financial statement, or there is a chance that a huge amount might go missing without the consent of the company's auditor or directors or the shareholders, there is a fraud, there is any misappropriation of funds, there is any illegal activity that is going on, or an error that has been conducted by the management, we will be able to detect it, identify it, and move through it. Okay, we will express an audit opinion on compliance with financial reporting framework. We will be expressing an opinion whether the financial statements are in accordance with or comply with the financial reporting framework or not. With that, we will be communicating findings of the report as per ISA, the things that we are going to find during the audit, the things that we are going to identify, the evidences that we are going to obtain are to be reported by the by the auditors to the governing bodies. Why now the main question here is, why do we need an external audit? The external audit is necessary because shareholders are separate from directors. Managers may have incentive to manipulate financial statements. The managers may have incentive to manipulate the financial statements. Financial statements can be manipulated, and the managers can have an incentive. Now, why is that so? Why can the managers? How can they have an incentive? Now, if I tell you a situation where directors bonus is subject to a profit of 1 million. Now I'm telling you that if the profit is of 1 million, the director will get a bonus, otherwise he won't. So will he have an incentive if he manipulates the financial statements and reach the amount of benchmark of 1 million? Yes, he will. So will he try to do it? Yes, he will. So there is an incentive for him to manipulate the financial statements. Then auditor provides independent verification of financial statements. In most countries, external audit are mandatory for large public companies by law. So mainly the key concept of having an audit is to gain assurance, to gain confidence in the company that if we are investing money in the business, in this particular company, everything that they're showing us is what is happening in the organization. Nothing is there that we should know about is not shown. For example, any kind of losses the company is bearing, it should be shown or reflected in the financial statements. If we are solely relying on the financial statements, if I'm relying on something, I need to make sure that this thing, that base is reliable or not. To get a higher confidence on the particular base, the financial statement, the reliability of a particular area, we need to get it checked by an independent person who will give us opinion whether everything is true and fair or not. In this way, I will be able to make certain decisions, whether investing, divesting, or holding on to investment, that will, in the longer run, determine my wealth for the organization. Okay. So my wealth is directly proportional to the level of reliability I have on the company's financial statements. Higher the reliability, higher the chances that I can get more informed decisions, I can make more good decisions according to the market, according to the investment, according to the divesting areas. Even when not required by law, some companies offer audit. Why? Because they're opting on audit for, they might be going to get the company listed in the stock market. If they're getting listed in the stock market, then they want to have assurance that the financial statement is going fair. They are complying with the regulatory bodies beforehand only. Further, the people who have invested in the bank, invested in the company, will need some more assurance that the company is operating efficiently. Some external stakeholders, such as the banks, the financial institutions, the suppliers, would want that if you get your financial statements audited and the audit report is sent to us, we will examine it and we will tell you whether we can give you a loan, we can give you a debenture, we can give you any kind of borrowing, and whether we will have a business with you in the future or not. So some companies might do this for the personal benefits of getting a loan, getting a debenture, getting excessive supplies, etc., etc. So this can be done. And other than that, if you are having audit, the chances of having a fraud in a company deteriorates. What does it mean? It means that if I have a guard in my uh, street, I have hired a security guard and he's guarding my street. Will it prevent having a theft completely? It might not, but it will enrage or enlist a fear in the hearts of the people that there is a guard present, and it could be difficult for us to have a robbery here. So we should try to look for some other place. We should not attempt this thing here because we might get caught. Same as with the auditor. if auditor is present and audit is to be conducted, people will fear that they might get caught. So they will avoid this activity beforehand. Okay. Some important concepts that we should know. It includes management, ISA 260. The management is the group responsible for daily operations and discussion of the entity. This includes what is the responsibility of the management? ISA 260. We will be discussing ISA 260 in the later on chapters as well. But right now, you just need to know what is the responsibility of our management and TCWG regarding the financial statements. Okay. So management is responsible for preparing the financial statements as they are working complete year. They are kept or they are responsible for having internal controls implemented and designed as well. So they are reasonably accountable for preparing financial statements, designing, maintaining internal controls, and preventing a detection of fraud. So here, one thing is clear that the auditor is not responsible for the detection or prevention of fraud. He is responsible to check the financial statements. But on the way, if he gets to know about a fraud, he will be then responsible that he should report it or give a clear view of what effect that the fraud brought on the financial statements or what could be the possible outcome of it. Now, the management typically includes CEO, CFO, and the finance manager or some similar executive, who are basically are people working in the organization. Now we have those charged with governance. Who are those charged with governance? Basically, they are the people. They are the people who are hired or who are kept or selected by the shareholders to manage the company or overlook the management, whether they are working in a correct order or not. They are independent people. They are working in the organization, not working on a day-to-day basis, but they are overseeing the work done by the management. So these people are bound by the law to see the organization's activities. Okay. Now, those charged with governance are the person or organization with responsibility for overseeing strategic direction obligations related to financial reporting. This may include BOD, board of directors, audit committee, and supervisory board. In small entities, TCWG and management may be the same individuals, but when you are talking about a listed company has to keep TCWG and their management separate. They will be responsible for the oversight of our management on the work they are doing, and they will be representing the shareholders. By representation, basically, I mean that the shareholders' interest is represented by the BOD to the management and discuss strategies to how to achieve that. Okay. Moving on, responsibility in relation to management and TCWG. So, preparation of financial statements is the responsibility of management, and oversight responsibility is TCWG's. Internal control, design and implementation is the requirement for management, and responsibility for TCWG is oversight and effectiveness. Fraud prevention, management is responsible for fraud prevention, but the TCWG has to develop a culture from the top and make sure the controls exist to prevent fraud. The auditor's communication is a significant area where he needs to provide representations and information from the management. He will be needing representations and information from the management, and TCWG will receive communication about the audit scope, finding independence, and they will make sure that the management is providing everything to the auditors or not. If not, then this will be a problematic area for us. As we will discuss, it will affect audit opinion in multiple ways. Now, written representation is basically auditor obtains a written representation from management that the responsibilities that are identified above are being fulfilled by the management and nothing has been left to someone else or the auditor. And the TCWG may also be informed of representation requests according some any activities that were happening in the organization. Now, if a particular representation or communication is not made with the auditor and some information that is required is not given to him, what will happen? This will happen in a lack of evidence collection documents. If we have less documents, we won't be able to get sufficient appropriate audit evidence. If we are not able to get that, our evidence will be weak, our report will be weak, and our opinion will tell everyone that the management management imposed limitations, due to which I was not able to extract the audit evidence and give you a true and fair opinion. So this will be an area where if you're not giving representation, if you're not maintaining communication, this can happen in severe cases. Okay. Then moving on, deficiencies in internal control. The management should be known about deficiencies identified. Any significant deficiency, anything that is out to a substantial level, is to be informed to the TCWG, not the management. In test of controls, we are going to discuss this area as well, where we're going to see that which documents or which topics are to be discussed with the management and which are to be discussed with the TCWG. And last but not least, approval of financial statements is done by the TCWG. Management has the responsibility to prepare it and sign it. That they are the people who are responsible for it. Now, auditor's communication required in with TCWG under ISA 260. The auditor must communicate the following to TCWG: the planning and scope and timing of the audit, significant audit findings, including significant accounting policies, significant risk identified, judgments made, and adjustments proposed. All of these areas are to be communicated to by the auditor to the TCWG in case of them being significant. And the auditor's independence, including the relationships with may affect it. That means if your family member, if your wife, your friends are there, you should report it first to the TCWG so that they can take appropriate safeguards and maintain the quality of the audit. Then fraud risk identified between the audit is to also to be communicated. Further, the timing, the communication should be made timely and may be written or oral, preferably written, so that in the future, when you want to go through that particular event or the quality inspector wants to check the quality of the audit, they will be able to see the documents and make a decision up for you. Example, a public listed company, management is a CFO and the finance team prepare finance statements. TCWG oversee the audit process and internal controls. The auditor discusses with the audit committee the planning, communicates material control weakness in the payroll. To see TCWG, you see a word here that is significant. Any significant control weakness is communicated to TCWG, and any immaterial small amounts are to be told to the management. And obtain a written presentation from the CFO regarding completeness of liabilities. So these are all the areas that an auditor is required to obtain, or public company is required to give to an auditor. So these are the tasks that I have to do. Now, when the management and TCWG are the same, when the management and the TCWG are the same, in small entities, the business or one person may act as both. Okay, the one person managing the business, the owner, will be acting as both TCWG and the management. ISA 260 requires the auditor to evaluate whether additional communication is needed with a supervisory board or external stakeholders, because now the oversight people and the working people are the same. So when the working people and the oversight people are the same, it will be difficult to maintain integrity, maintain our financial statements, agendas to be presented. The directors are representing shareholders, so no directors, no representation from shareholders, so direct communication by the auditor would be required. Auditor still documents communication but tailors it appropriately according to the company's entity's performance and position. Okay. Now, one thing you need to remember is TCWG is basically an independent body, sort of independent body. They are representing the shareholders, and shareholder has hired an auditor, a third party, so that they can check whether the TCWG and the management has not colluded. They have not combined and started something that is fraudulent, not allowed. They are here to check that everything is true and fair, the financial statements made, the workings done are appropriate with IFRS, and the external auditor will be required or responsible for the evidences he obtained for the opinions that he have given. So in every public company or a company that is required by law to have statutory audit or have a statutory audit are required to have all of these things maintained. If they are maintaining all of these things, the auditor will be required to give an opinion that is close to reality, not far from that. If audit opinion is incorrect, it is basically known as audit risk, that we give a wrong opinion. We have to minimize this as well. The lower the audit risk, the higher the chance that we will be able to give a good audit opinion, and it will help us in understanding or continuing the agency's work and give the opinion on whether people should invest or divest in the organization with their understanding of the financial statements. Okay, so for today, we'll keep it in here, keeping the lecture precise, concise for you. We will start with our engagement partner in the next lecture. Till then, enjoy learning. Allah Hafiz.